Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for years, around a decade, actually. He's been publishing his newsletter since 2014. His newsletter is Forest for the Trees. Luke Gromen, thank you for joining me.
Great to be here, Jason. Thanks for having me on.
So, Luke, we're recording this interview on Monday, November 6, 2023. The dollar index is down a little bit at 105.25. I want to get your thoughts, though, on all this craziness that's going on. What do you think are the biggest problems in the global economy right now?
I think ultimately the biggest problem is a fundamental mismatch between the price of commodities broadly, oil specifically, that we need to drive the production incentive to grow commodity supplies. In other words, we need higher oil prices to find more oil and other commodities to drive the commodity supplies to support the growth that's out there. But the problem is that the amount of Western sovereign debt, in particular sovereign debt globally, that we have cannot afford the inflation rate that we need to drive the supplies of commodities. So it's this fundamental mismatch where we need higher inflation to drive commodity supplies than the governments can afford. And I think we're just in the throes of volatility that this has caused. And I think it's ultimately going to be resolved by Western central banks following Japan's lead and doing yield curve control, including the Fed.
That's a surprising answer that you gave. I thought you were going to say total debt in society or problems with government debt, the levels of government debt that have increased since the 2008 financial crisis. I think we're at over 100 trillion total debt increase since 2008, the global financial crisis. So at all levels of society. Interesting point you brought up, though, about energy. I mean, I think a lot of the problem, Luke, is policy, because we've had a lot of these Western governments. They've been pro ESG policy. I call it the energy spending grift. So they've been blocking a lot of investments in oil, natural gas. I mean, we see these headlines that these countries are building liquefied natural gas import facilities, but no one wants oil and natural gas drilling in their own country.
Absolutely, policy is a big part of the problem. There's a geological aspect to it. In other words, it's not that we're running out of oil or running out of gas, but it is that the stuff we're finding it's more expensive. It's deeper. It needs to be fracked. It's not as simply produced as it used to be. So there's a geological aspect. There's a policy aspect that is a very big part of that. And yeah, that at the end of the day, those two things in particular combine to make for much more expensive commodities that we all need to improve our lives.
Oh, I totally agree. I see higher price floors for all these commodities. If you listen to the conference calls, whether it's copper mining, gold mining, oil, natural gas, the input costs are up across the board. And it's not just with higher interest rates and cost of capital. I mean, you have the workers, a lot of labor wants, especially in emerging market, they want much higher prices. They want much higher prices for their labor for a lot of these mining unions. Look at Penasquito in Mexico and many other countries. So all these input costs are up across the board.
Yeah, the input costs are up across the board. And then a key metric, too, that is, I think, still underappreciated, particularly in the West or amongst a lot of Western economists, is the concept of net exports, right? So it's not there's oil production. Well, I'm just going to use oil because it's the easiest one, but you could apply this to any number of commodities. It's not just a question of what's oil production. It's a question of what is oil production minus what each oil producer consumes for their own usage. And when you subtract domestic consumption from their production, what's available is your net export availability. And the issue is that historically, some function or some portion of Western policy has been geared toward minimizing the domestic consumption of these oil and other commodity producers across what I'll call the global South, quote unquote. And when you hear about global growth, BRICS, global South, etc., what you find is that they're going to start consuming a lot more of their own production. And so when I look at things and see China right now already is the world's biggest oil importer, has been for a number of years. They still only use 1/5 the oil that the US does per capita. India is 1/15 the US's oil consumption per capita. And that right there is a third of global population. So when you start seeing these net export numbers, when you start seeing domestic consumption, it does not take a lot of domestic consumption increases across the oil producing global south, where they start wanting to use their own production to improve their own lives and improve their own standard of living and mimic the Western standard of living. And that leads to a situation where the net export availability of oil doesn't decline linearly, it declines non-linearly, which implies at some point in the cycle explosively higher prices unless something really big changes, either on innovation or a number of other factors.
Well, plus China has locked up with long-term supply contracts over the last 10, 15, 20 years, a lot of that oil that's exported. But you're starting to sound like the peak oil guy from 10, 15, 20 years ago, Luke, who was talking about the land export model. So you had a lot of oil exporters like Iran, Iraq, Saudi Arabia, Venezuela. They used to export mass amounts of oil, I think Indonesia too. And then all of a sudden their oil exports just rapidly declined because they were subsidizing a lot of their domestic consumption. And then some of them, even like Indonesia, they were kicked out of OPEC because they couldn't export a lot of oil.
That's exactly what the model is. I think it was Dr. Jeffrey Brown did that model, and that's exactly right. I mean, that's what we're looking. I mean, Indonesia, if I'm not mistaken, has been talk about export controls on metals recently. Lithium, or not, was it lithium? I think it's nickel. And the IMF is not happy with them about that. They're looking at it and saying, look, you guys are going to take all this nickel and you're going to value add it and you're going to make cars and batteries and all this stuff. Well, guess what? We want to capture a greater share of that value add. So we're not going to export nickel. We're going to value add it here, and then we'll sell you the value added product. And it's a huge sea change. It has huge implications, not just for commodity prices, but again, then when we factor back, if we were in a society that had low debt, if we were in a society that Western sovereigns in particular had low debt, it wouldn't matter. The problem is that this is going to be very inflationary. And again, if debt was low, who cares? You pay a little bit more, bad businesses go away, is what it is. We're not in 1980 anymore. We do not have U.S. federal debt to GDP of 25, 30, 35%. It's 120% and rising again. So now, I don't know what the rate is, but it's we're what, 5.25, 5.5 the Fed funds. I don't know if it's 6 or 7, maybe it's 8, but it isn't high from here where you get into a very uncomfortable situation where the U.S. really can't afford much more than interest unless the Fed prints the difference. And that gets into a currency issue. So to me, that's this fundamental mismatch between the inflation needed to spur the commodity production growth that we need to support the debt and the incompatibility of the inflation rate that implies relative to the Western government debt. They can't afford the rate, not without money printing.
That's funny. You're talking about commodities. I mean, I don't hear any of the people in policymakers in the West really talking about any of the stuff for key commodities. I mean, I think the Department of Energy just brought up that maybe we need to start stockpiling copper or some of the other strategic metals. But in general, the policymakers, and I live right outside of Washington, D.C. for over 20 years, they just don't talk about it. I mean, they just assumed, which is ridiculous. They just assumed that there would be plenty of commodities to buy on the futures market or get delivery of it or negotiate with a miner. Well, China has locked up a lot of that commodity supply, and China has been the majority buyer of whether it's base metals, gold, tonnage, oil, and other energy or foodstuffs for the last 10, 15, 20 years. They've been the majority purchaser or importer.
Yeah, that's right. And I think it's been something that Western policymakers, U.S. policymakers have been ignoring for a long time. And I think they've started to wake up to it in the last 3 or 4 years. But this dynamic that I think China was early, along with Russia, in waking up to this mismatch and realizing, okay, the Americans have whatever it is. Now we're up to 34 trillion in debt, 100 trillion in entitlements. And let's make some assumption about what oil supplies are going to do, copper supplies are going to do, nickel supplies are going to do. And we know that either the debt or the amount of dollars, depending on if the debt is allowed to grow or the dollars are printed, we know exponential math is going to do to the US debt, sovereign debt, and Western sovereign debt what it's going to do. What we don't know is that commodity supplies are going to keep up with that. And so what we've started to see 10, 15 years ago, led again by China and then Russia as well, a move where they still accept dollars, but then they turn around and they redeploy those dollars not into treasury bonds, but into commodities in the ground, into gold, right? So when you see China buy a 20 or make a 27-year LNG deal with Qatar, and then do a second one, that is essentially swapping dollars for commodities. That's rather than storing dollars in treasuries and then selling the treasuries to get the dollars to buy the LNG when you need it over the next 27 years. That's cutting out the middleman. That's cutting out the dollars, cutting out treasury bonds, and just saying, here, you take the dollars, and we will take the supply of the commodities over the next 27 years.
And the People's Bank of China, to add to your points there, I think the last 9 months, they've been large purchasers of net tonnage of gold, along with pretty much all the other non-G7 central banks. That's been a common theme lately.
Yeah, I think, and we've seen, obviously, Russia's been doing that as well since 2008, where they've grown gold holdings meaningfully. They were still growing treasury holdings for a bit, and then in 13 or 14, around the first Ukraine conflict or disruption, sanctions, whatever you want to call it, they sold all their treasuries, basically. Russia did. So there's this is I think a realpolitik recognition from China's standpoint, from Russia's standpoint, from others, that that they're the commodities are more finite than the debt and the dollar is going to be. And so that's been the trade. I mean, 10 years ago, there was an article in Reuters about how China had largely already monopolized an OPEC country's oil, Ecuador, for the next 20 years. That was in 2013. And so they were way ahead of the game on this. And like I said, I think there has been a waking up, probably started under the Trump administration, amongst some policymakers. I think defense and intelligence people were ahead of the game here a bit as well, based on some of the things I've heard. But here we are, I think, and that is again, I think that is the biggest fundamental mismatch in the global economy from a macro perspective.
Do you think that this is partly why deglobalization is happening, why we're seeing like a lot of nationalism, a lot of, I guess, pro-tariff policies where the countries want to do the domestic manufacturing or keep their resources in-house, or they already have the supply contracts to China and they're not going to sell it on the international markets for dollars? You're going to see a lot more deglobalization then going forward?
I do. And I also think it's why we've seen a lot of the geopolitical tensions we've seen, because ultimately, I think there's two chief sponsors to this. I think China is a chief sponsor, and I think Russia is a chief sponsor. And so I think the transition of China and Russia from we love China and we love Russia 10, 15 years ago to public enemies 1 and 2 over the last 10, 15 years, I think is in no small part Russia being really a key leader to this. Basically, you know, if you need a nuclear armed oil and commodity supplier to do this, and Russia's been happy to do it. And China, it's a matter of national security for them to do this. Otherwise, they're going to have a currency crisis. They're going to run out of dollars to buy this stuff. They'll have a currency crisis, and their economy will collapse, just like happened in Southeast Asia in '97. So it adds to the geopolitical tensions around the world, because it's a red line for them and it's a red line for us, or for at least parts of us. I think ultimately it's really good for the U.S., but it's inflationary and it's bad for incumbent parties in power in the U.S., namely, certain Washington, D.C. interests and certain Wall Street interests.
Well, I think they've been benefiting for decades from the Cantillon effect and asset price inflation. The people here in the DC metro area from the government spending, both political parties in Congress and the White House just increasing spending. But the policymakers in DC, look, they just keep doubling down on stupid policies, I think, for foreign policies and sanctions. Did you see a couple of days ago, it was over the weekend, they put even more sanctions on the new liquefied natural gas project that Russia's building. So it's just head scratching all the policy blunders that the people in DC continue to make. See, I mean, I would argue that the people here in the DC metro area, and I've lived here for 20 years, they profited handsomely off government spending increasing. When you ask people in both political parties, I mean, they're talking about spending increases. They don't care about the debt because they're making many millions of dollars, 6-7 figures extra per year or every couple of years on all the insider trading and extra deals that they get for their clients if they're a lobbyist or the people in Congress, insider power.
I didn't see that one specifically, so I'm answering without knowledge of that, but I think it's very clear why they are trying to isolate Russia, which is Russia's oil and commodities gives Russia the ability to force a change in the system. And Russia is doing that. They're attempting to do that. And that will ultimately be a much better and more balanced monetary system, financial system. But it's not great for certain Washington interests. It's great for Washington, D.C.'s primary business is the debt export business, right? They export treasuries. That's America's biggest export from 2002 to 2014 with treasury bonds. We exported 12 trillion of treasury bonds. If you look at the increase in FX reserves. Our FX reserves grew by 12 trillion, 60% of that, we'll call it, were treasuries. So say it was or were dollars. So $8 trillion in dollar exports, by far and away America's biggest export. What Russia is doing, what China is doing, will force a rebalancing that will force America to produce more of its own consumption and force the rest of the world to consume more of its own production, which necessitates a radical reordering of global currencies around balance of payments, which is to say a much weaker dollar, because we've got the biggest deficit of anybody. The British are slightly less bad than us, although with a less diversified economy, smaller landmass, et cetera, they might actually be worse off than we are. But I think that's why Russia is, and has been under Putin for the last 15 years, increasingly persona non grata number one, is he's trying to make a change to the system, to the monetary system, by virtue of what, and he has the means, motive, and ability to do so by virtue of his share of global commodity markets.
So we're in agreement that I think there's maybe some short-term price action where it could either go sideways or down for commodities. But long-term, I think there needs to be a lot more investment in CapEx and for new supply, because I see demand rising. I know there was a narrative out here that global energy demand was going to collapse, that oil demand had collapsed, that people were going to all switch to electric vehicles. I don't think we had the investment or the infrastructure in place for all these countries, especially here in the United States, for everyone to switch over to electric vehicles. So I see oil demand continuing. We're seeing that in a lot of emerging market countries outside of China, actually, where people are transitioning to motorcycles, electric scooters, smaller cars, smaller SUVs. So that transition is still ongoing.
Yeah, I think that transition, I think that's exactly right. It's a lot easier to transition to electric vehicles when it's sort of your first iteration, where you don't have an installed base of, whatever we have in America here. What is it, 280 million cars or something like that? The installed capital base there is just so large. It's very difficult to do. And, to your point, we don't have the electrical infrastructure. It's not even close. And so when you start looking at some of the implied electric vehicle numbers that some people have thrown out, and then you start looking at what that implies for some of the technicalities on the U.S. grid, we're putting the cart we're putting like 10 carts before the horse. So, for me, when I hear peak oil demand, I sort of take it with a big block of salt. Human demand for energy is infinite. I would take a helicopter everywhere I could go. I would fly a Gulfstream 5 everywhere I could go if I could afford the gas. I cannot, so I don't. But ultimately, that is a dynamic. If oil, there is no historically demand for oil has been rationed via the dollar, right? Oil was only priced in dollars. Commodities were only priced in dollars. We are seeing Russia and China and others moving to trade oil and other commodities outside the dollar. Once you can print your own currency for oil, you start to use a lot more of it. We can see that with the US post 1971. So to the extent China is gaining the ability to essentially print yuan for oil, they're going to consume more of it. To the extent others can't, they're going to consume more of it. And we just were talking about earlier that the per capita consumption of oil across much of the global south is tiny compared to the US. And it is also, a lot of these places are producers. And to the extent they're producers, the net exports available for everybody else begin to drop off fast. So it's a huge change. It's multi-pronged. It has huge second and third derivative reflexive impacts into debt markets, currency markets, etc. So it's a big deal in my opinion.
I think you've just described a very clear math problem with DC spending and a lack of demand for the amount of US Treasury supply that DC wants to sell.
And we've been seeing it. I mean, it's realistically in 2014, global central banks stopped growing their holdings of treasuries on a net basis. And that set off a slow moving but very predictable set of symptoms in financial markets that we've been describing for clients for some time. The biggest, up to 2014, the biggest and the least price sensitive buyers of treasury bonds had been central banks. And so when one of your biggest buyers, who is the least price sensitive buyer, stops buying on net, you start to see you need to find new buyers. Those buyers aren't just price sensitive, or are more price sensitive. You see more volatility in treasury markets. You see a lot of different dynamics, but it's now coming to a point where it's much more coming to a head in terms of the mismatch between supply of treasuries and demand for treasuries. And critically, people say it's all a question of rate, with which I agree. However, it goes back to the initial point. Our debt is now so high, there is a rate that the US government cannot afford. The rate at which US interest expense is pushed above US tax receipts isn't as far away from here as anybody would like to pretend. And that is a point that is very, very inflationary. So, once interest expense gets to be too big as a percent of receipts, you either lay off the Marine Corps and the Navy and the Army, and you tell 70 million boomers, sorry, we need to slash your entitlements by a lot permanently starting tomorrow, or the Fed prints the money and the dollar suffers. And that's what we're heading toward.
Yeah, I think you lay that out. You've talked about yield curve control, Japanification. Lynn Alden has talked about this type of stuff from the 1940s, similar to wartime type scenario where the government intentionally inflated the debt away. I think they sold war bonds. So we're headed towards that type of scenario. The math just doesn't work here because DC doesn't want to cut spending. Aren't we on pace for around $2 trillion per year in budget deficits? And now you've clearly demonstrated that there's a lack of US Treasury demand, especially on the long end, because it appears there's like a dislocation now. Retail investors, hedge funds, they're going to the 30-day Treasury for 5%, but there's like almost very, very little demand for longer duration Treasuries.
Well, it's been a pronounced shift, right? So central banks stopped buying, so then it went to foreign private, and then it went to foreign private. It shifted to U.S. banks and U.S. hedge funds and U.S. retail, and there's been sort of this daisy chain of people or of entities either regulated into or incented into via regulation or in the case of U.S. retail, straight rate hikes to make the debt more attractive. But at the end of the day, we can clearly see that the demand for at the long end is not nearly strong enough to term out the size of deficits we're having. I mean, we can argue about, okay, is there no demand? Is there a lot? Here's what we can tell, right? Either, and you saw Stan Druckenmiller and Paul Tudor Jones talking about this a week or two ago. Stan Druckenmiller saying that he didn't understand why Yellen and Mnuchin had not termed out the debt, and Treasury comes out and says, "Well, we're not in the business of gaming the markets," and on some level, I understand that, but they weren't worried about gaming the markets 20 years ago, 15 years ago, when the debt levels were low. The fact that they have to worry about gaming the markets is in and of itself a signpost that the debt is so high that gaming the markets starts to become a concern. And bigger picture, Mnuchin and Yellen aren't stupid. So why didn't they term out the debt with rates at or near 5,000-year lows? A, they were stupid. B, the long end of the curve is a lot less liquid than most people think. And when you sort of boil it down to that, in my opinion, the Occam's razor explanation is B. The long end is a lot less liquid than everybody thinks, at least as it relates to the amount of the deficits, the $2 trillion a year deficits. We're running almost $2 trillion a year deficits in a good economy. And as a number of people pointed out, the 10%, the 10-year Treasury is the real policy rate for the real economy. So if you try to term out too much of that $2 trillion at 10 years beyond 7, 10, whatever at the long end, you're going to blow out rates on the real policy rate of the economy. And we know sort of what that looks like because we got a little glimpse of it earlier this year with some of these banks who got upside down in their longer dated Treasury portfolios and what we're seeing in sort of the freezing of commercial real estate and et cetera. So it's the fiscal situation of the U.S. has gotten acute, and it's been an overnight 10-year, a 10-year overnight surprise, where all of a sudden in the last couple of weeks, the Treasury and with the refunding announcement last week and some of the TBAC reports last week, very eye-opening. They're saying the quiet parts out loud. There's a fiscal problem. There is a supply-demand imbalance.
So by gaming the markets, do you mean that the Treasury is lying about the real inflation rate, lying that there's actual real demand to buy these longer duration Treasuries? What do you mean by gaming the markets exactly?
No, they just mean at least this is how I took it, to be operating like a hedge fund manager, right? Like, okay, hey, we've got $2 trillion to place and the 10 years at 1, so let's plug as much there as we can, and then we'll take this slice and we'll plug, really trying to trade it for maximum efficiency or for maximum profit, as opposed to like a hedge fund manager would, as opposed to very predictably, okay, here's how much of the issuance is going to be 10, here's how much is going to be 7, here's how much is 5, here's 3, here's 2, here's 30 days. And we'll deviate from this a little, but that's what they mean, is they don't want to try to whip it around like hedge fund managers to try to sort of maximize the Treasury's profit, basically, right, to the extent of the markets. And on a number of level, like, I get that. I think that's probably the right thing to do. With that being said, when the deficits weren't 6 to 8% of GDP in a good economy, that wasn't even really an issue. Like you had that flexibility. They no longer have the flexibility. Even if they wanted to game the markets, they can't.
Okay, I see. The other thing here, I think that a lot of people didn't expect, and I've heard this from bankers that have come out, newsletter writers that have bankers as customers that are paying for their research. A lot of regional bankers said, okay, fine, if the Fed raises rates, we're okay for 6 months or something like that. But here we are over 18 months later. These banks, whether it's regional banks here in the United States, Bank of America, which I have hedge fund managers telling me Bank of America is insolvent, literally. And then I think, like, with the dollar index where it is and the amount of losses on Treasury bonds, I think these private foreign banks, they have trillions of US Treasury bonds with losses. So what in a scenario, what happens then if these losses on bonds, they continue to accumulate and we have a bond bear market that continues to last for years longer than the current record 3 years already?
Yeah, I don't know what ultimately, I can tell you, I don't know any specific bank one way or another. I don't have any opinion on that. I can tell you what the end game will be, which is they're going to have to choose the banking system or the dollar. And in my opinion, they're going to choose a dollar. In other words, they got to let the banking system go or they got to let the dollar go. They got to let the banking system collapse or they got to let the dollar fall sharply. And they're going to choose the dollar. They always choose a dollar. It's a question of how they do it, when they do it, how much pain they allow first. And critically, in terms of trying to time that, I think the biggest signs are when the Treasury market gets sloppy, right? Once the Treasury market starts to be very illiquid, when it starts to dysfunction, when the volatility rises, that's when they tend to come in with the dollar liquidity. So I don't know how I don't know the path from here to there. I know, given what we're seeing in Treasury volatility, what we're seeing in Treasury liquidity, that we're probably already into the window's open for more dollar liquidity to start. But that's what's going to happen. Is ultimately they'll increase dollar liquidity and inflation will resume and move higher again.
So by dollar liquidity, you mean covert bailouts, kind of like the Fed creates a new shadow liquidity program here for domestic banks like BTFP, which they don't count on their balance sheet. They loan out at par for whatever toxic collateral, similar to the 2019 repo crisis, or at the central bank level, what a currency swap line in dollars to a foreign central bank like the European Central Bank or others. Is that what you're referring to?
Yeah, it can be. Yeah, exactly. It'll be repo rate. With repo, it's not QE, right? It was QE. They didn't want to call it QE. It's dollar liquidity. Exactly. BTFP last fall, it wasn't from the Fed, it was from Treasury. If you remember, there was an IMF meeting in Washington in October. The dollar was a subject of high concern amongst U.S. trading partners and allies. And Yellen ran down the TGA at a very aggressive pace, more than offset Fed QT. And the dollar weakened by almost 15% in 4 months, which is an enormous move down in a major currency like the dollar. So once you get the dollar down, that provides liquidity to the system as well. So there's any number of ways they can do it. I'm agnostic as to how they do it. And I think the things we're seeing in Treasury markets are suggestive that they're gonna have to do it soon. The dollar is, it's very interesting. I mean, we got the Treasury move volatility index back in early October, hit a level that it had last hit in March of 23, September of 22, March of 20. In each of those times, U.S. dollar liquidity was brought to bear. I don't think we've seen much, if any, liquidity yet. But what we did see is in the ensuing 8 trading days, 7 different Fed speakers come out and jawbone the dollar down, saying the bond market's done our work for us. Bond market's done our work for us. Bond market's done our work for us. So the dollar traded as high as, I think it touched 107. It's back to 105 and change, traded at 104 earlier today. So they've got the dollar's the key linchpin. If they can keep the dollar moving down, they can buy themselves time. Challenge in all this is it's all a matter of time. So the dollar keeps moving down at least as much as they need it to move down to sort of fix one hand of the problem. Pretty soon, inflation's going to pick back up, and then they've got sort of a different side of the same problem.
Yeah, or there's not enough investment then on the oil and energy side. So even if the other commodity prices are down and then the government statistics say that inflation is not a problem, then you have a rally in oil and energy then if the dollar starts to get too weak.
Yeah, and that's, ultimately the only way out is a sustained period of very significant inflation with the Fed capping rates to the real rates are negative. Basically, you either have, when you have a problem and there's too much debt, there's 2 ways out. You write off the debt, or you devalue the debt with inflation. And that's sort of where we are. And there's a lot of gnashing of teeth and debating, and it's a political issue because, it's the creditors against the debtors. And ultimately, the government's the biggest debtor there is. So my view continues to be that when push comes to shove, bonds will lose money on a real basis for a sustained period of time. And once they've been devalued enough relative to the underlying economy, sort of move on.
According to your estimates, how much of the US Treasury debt needs to be refinanced at higher rates in the next 12 to 24 months?
Oh, I've seen this number. I want to say it's like 40% over the next 18 months, something like that. But I don't know that number detailed off the top of my head, but I want to say that's roughly the right math.
I think it's over 7 trillion in the next 12 months. But I mean, it looks like the Treasury last week played games, and their number that they raised in the Treasury bond market was lower than the estimate. So that kind of got like the stock market to rally. So they can still play some games. In my opinion, Luke, I think the dollar index and the dollar is like managed. So they try to keep it in a range. They don't want it too high, because if the dollar goes on a rip your face off rally like a Brent Johnson scenario, that's like a global margin call. That's defaults on dollar denominated debt, defaults on banks. So they try to keep it where it's not too high and not too low. And that's basically all they can do since 2008.
Yeah, I think it's a fair assessment in terms of they'd like it not too high, not too low. I mean, we can certainly see it has been in that range. And that's where it gets into the challenge, why I think the energy side is so critical, right? Because they can manage all of the paper. They can manage the paper. They can manage the dollar in a range. They can manage the debt. The oil is managed by geology, and the oil's either there or it's not. It's not like a lot of this other stuff you can extend and pretend. When I go to fill up my truck, there's either gasoline there or there's not. And that is why I think the point I let off with at the top of the show of the dynamic of the of the energy relative to the debt, of peak cheap energy relative to the debt, is so critical. It's great you can keep the dollar in a range, but what you need the dollar to do in order to get oil to do what it needs to do in order for US shale, which has been 90% of global oil supply growth over the last decade, to grow, what that requires is the dollar going down a lot for a number of years. And every day that we spend keeping the dollar in a range, or worse yet, the dollar going up, the further behind the curve we fall on a lot of this commodity stuff, which then you either need to slow the economy, which again, is a short-term solution. Ultimately, you can't pay back debt at this level when you go into recession. You go into recession, the West and the world broadly is going to have a debt spiral.
Well, plus tax receipts collapse. And in my opinion, the real reason for quantitative easing, whether it was in 2008 or 2020, was to plug the hole from spending at all levels of government. The Fed had to monetize the debt and buy all these government bonds, even municipal bonds.
Yeah, I agree. I agree that QE was ultimately about financing the government. It is about keeping Treasury solvent. Yeah, so that's they can do all those things, but they can't fake oil. They can't fake the physical commodities. And that's where that's where it gets tricky, in terms of trying to manage the process. And that's why I'm so focused on it as a forcing function for sort of understanding the interplay between these things.
Well, the other thing the Fed is not, and DC is not taking into account, is when the Fed tries to fight inflation, right, by raising rates and quote unquote killing demand, because that's one of the only tools that central bank policymakers have besides reducing the balance sheet. They're actually causing lack of investment then on all the commodities and the supply side, because an investor, if you have millions of dollars, you're saying, why should I invest in a risky oil well drilling project when I can earn a quote unquote risk-free 5% on a 30-day US Treasury bond? So they're actually going to restrict a lot of the supply then. I'm sure they're not thinking of this.
Yeah, I would tend to agree. I have, when we did what we did in 2022, from a policy standpoint, the United States. And what I mean by that is aggressive Fed rate hikes and running down the Strategic Petroleum Reserve, or SPR, to cap oil prices to fight Russia. It was a penny wise, pound foolish move. In the short run, absolutely. It put pressure on Russia. It reduced oil prices, reduced oil revenues. Great. However, Russia has not as much oil production than us on a gross basis, but they are a bigger oil exporter. And importantly, they have a lot more conventional oil and gas production than we do, which means their oil and gas production declines a lot less slowly than ours does. And so if you put in what were essentially price controls on oil, you ask any economist on Wall Street, what do price controls do? And they'll tell you they work in the short run, and then they make the shortage worse in the intermediate term, and make the price spike worse in the intermediate term. 2022, the United States put in price controls in oil. We raised rates aggressively, and we reduced, we ran down the SPR. And we can see U.S. rig count has rolled over. We can see, we're seeing EIA production numbers still hitting records, which is sort of weird because of the four big basins, only the Permian is still at or near the highs. We will get some more deep water coming on with price, but now that we're 18 months on, we're getting into a situation where we're getting into the bad end of price controls.
And we've seen this for decades in gold and silver markets with the futures contract and the paper price manipulation. I mean, it's created a lack of investment on the supply side for gold and silver mines because, I mean, the cost for a lot of miners go up. The grades, the ore grades for gold and silver, they've collapsed in the last 10, 15, 20 years. So it's just not economic to mine gold at $500 an ounce or silver at $5 or $10 an ounce. We're scraping the bottom of the barrel for grade. Same thing for copper. There's just not the incentive to bring on new supply. So all the paper price manipulation is going to create shortages and cause the mining costs to go up.
Yeah, and importantly, for gold and silver, gold has a stock to flow ratio of, call it 60 or 65, right? So of all the gold that's ever been mined is 65 times the amount of production that we do on an annualized basis. So silver is like 30 stock to flow ratio. What this means, the way to think about stock to flow ratio is the amount of shells there are to hide the P under, right? So the bigger the stock to flow ratio, the more you can separate physical fundamentals from the paper price. And so it's been very easy to separate the paper price from physical fundamentals at key times in markets like gold and silver. The stock to flow ratio of oil, when inventories are tight, it's like 1.1. And when they're loose, they're like 1.2. And so you can't, the point here is that they can play the same games, but they're going to get caught very, very fast in terms of when physical markets reassert themselves over the price controls.
Let me add to your point there. Also, I'm not sure if you saw the Saudi oil minister made comments about this in February or March. He said there's a ton of paper futures contract manipulation on the oil price. He said, fine, we'll just start cutting production. So he was warning about that with the games that you were mentioning with the SPR releases and the paper futures contract. He said, that's enough. We're just going to start cutting production.
Well, and they said at the end of 21, I can't remember if it was a Saudi energy minister or OPEC energy minister, but they said, if we don't invest, I forget how many trillions. I mean, it's like tens of trillions of dollars into energy, into oil infrastructure, discovery, production, then we're going to be 10 or 20 million barrels a day short come, I want to say he said 2027, which is no longer that far away. And I think the bet in the West is, well, don't worry, we'll just switch it. 40% of our oil demand on a daily basis in the US is automotive. So we'll just switch everybody to electric by 2026. Right? We had all these automakers come out a couple of years ago and say, oh, we're all going to switch by 2026. And they all just happen to pick 2026 at the same time. But we don't have the electrical grid to even come close to doing even a significant minority of our autos by 2026. It's not even close.
I don't think anyone does.
Yeah, no one does. Some are in better shape than others, but they're all not in great shape. And critically, if you came out and said, we need to do it in a big hurry, it's 2024, we're gonna, let's say Biden wins the election and he says, okay, now I can do whatever I want. I'm a second term. We're going to really do the Inflation Reduction Act industrial policy, which, by the way, I don't think is a bad idea. we're going to print $2 trillion to upgrade our electrical infrastructure over the next 2 years. And the bond market goes, bleh. So, again, when your debt is low, you can do that. When your debt is high, you cannot. And so when the bond market goes blah, then what? Then you get what we saw in the UK last fall. Either the Biden administration comes out and says, okay, we can have the U.S. Marine Corps and the Navy and the Army and who am I forgetting? Army, Navy, Air Force, Marines. Okay, we can lay those guys off and do industrial policy and pay interest and pay the boomers, or we can lay off the boomers and their benefits by a significant amount immediately, or we can have the Fed cap yields and do it all, and the dollar suffers. And historically, it's always the latter choice that's made. So
there might be a third choice. There might be a third choice here. I mean, if there's no Fed audit, they can print off balance sheet and special purpose vehicles, trillions, monetize debt that way, and there's no way to prove or disprove that it's actually happening.
Yeah, but it'll show up in the markets and the commodities. It'll show up right when the spending for the infrastructure happens, when the hiring for the infrastructure happens, it'll show up in markets. They won't be able. I mean, they can pretend they're not, but it'll show up in prices.
So I want to wrap up the interview here with one more question. I know you've done a lot of work on this and a lot of other people haven't. So you were ahead of the curve on this. And we were talking on Twitter on this over the last couple of years about U.S. government tax receipts. So they've dramatically changed a lot in the last couple of decades. I know you were posting charts about this, and I was too, last couple of years. So government tax receipts for asset prices, so stocks, bonds, real estate, capital gains, wasn't it around 10% of annual tax receipts were relying on capital gains taxes, in the 1990s? And it's changed dramatically since then.
Yeah, the way I always looked at it was, and I noticed this back in the early years of FFTT in 2014, I went to the IRS's website and I started looking at the data, and what I found was that net capital gains plus taxable IRA distributions alone were roughly 200% of the growth in annual personal consumption expenditures, or PCE. PCE as a category is very broad. It's what we typically define as consumer spending, and it's roughly 2/3 of GDP. So I looked at this and said, oh my gosh, the US is a consumer economy, 2/3 GDP. That 2/3 GDP cannot grow mathematically unless asset prices, net capital gains plus taxable IRA distributions, are rising, which is primarily the stock market. So unless stocks rise...
Well, and home prices too, yeah. Those are the other one.
And critically, that's just net capital gains and taxable IRA distributions. The reality is that stock options and executive incentive comp is taxed as ordinary income. And that is the holy grail magical number that is very, very difficult to get to. Nobody knows where that number is or what that number is. However, that number is then on top of that 200% of PCE, 200% of the annual growth in PCE. So when I was working at a bank and received quarterly options grants when the mortgage market was humming, and we were very mortgage-centric bank, and it was like several $1,000s free every quarter. Here you go. Stock grant. Stock just goes up and up and up because we're giving away mortgages to anyone who can fog a mirror. And that was all taxed as ordinary income. And so when you see, you have to go back to 1995. Bill Clinton signed tax legislation that ended the tax deductibility for cash compensation for executives over, I believe it was $1 million per year. So if you're a CEO of XYZ Corp and you make over $1 million, anything over $1 million, the corporation can't deduct from their expenses for earnings. And then it exempted stock-based comp. So guess what everybody did? They started taking huge amounts of comp in stock. And that's when you can see, starting in 95, if you look up charts of CEO comp relative to the average worker, it was extended and it just completely blew out after 95. from a tax receipts, and of course it filtered down from the C-suite down to the mid-level. So now corporations, they pay a lot of people a lot of money via stock comp. And it's all taxed ordinary income. It's all based on the stock market, but it doesn't show up in capital gains and it doesn't show up in taxable IRA distributions. But it does show up in the tax receipt data, because if you run the tax receipt data from, on the Fed's website on a year-over-year basis from, call it 1960 through 1995, the correlation between the stock market and federal tax receipts is tenuous at best. Sometimes it rhymes, sometimes it's actually anti-correlated, but whatever. Starting in 95, it becomes very correlated with stock market leading. And it's gotten more so with each successive cycle, such that stocks go down and then tax receipts go down by a similar amount on about a 6-month lag. And so when it was really interesting, because I really thought more people knew about it. And then you see back in September of this year, Washington Post, New York Times, Wall Street Journal, household Washington consensus economists saying, wow, the deficit just blew out. In a good economy, this doesn't make sense. And I was thinking to myself, like I've been screaming from the rooftops, this was going to happen. The United States economy is now basically on the margin, the stock market. So if you knock the stock market down, you knock down the stock market, you're going to knock down tax receipts by a similar amount. And it happened. And the good news is with the stock market bounce we've had off the lows over the last 6 months, you are seeing a bounce in receipts, and you will continue to do so. But it leads to this, again, this pro-cyclical dynamic where people say, well, we just need to raise, okay, Luke, there's a treasury supply demand problem. You're right. We'll just scare people out of stocks into treasuries. Like, no. That's not a friggin' option. Like, and I
would crash tax receipts. Yeah.
And I've always said that, but this year I don't have to assert it anymore. I can prove it. I hold up the chart and I go, here you go. Stock market fell. We had a rough stock market year last year, but it wasn't like the worst ever by any stretch, and it bounced back pretty quickly after September, October. And tax receipts were down $500-600 billion just from that part, just from stocks on the capital gains side, or on the non-withheld is what they call it, right? So that's cap gains, that's taxable IRA, that's stock comp stuff, right? So $500 billion, give or take. That's $500 billion more in issuance. So now you say, well, we'll just really crash the economy. Like, no, that's not a policy. I mean, it is a policy option for like a moment, but it's like burning all of your furniture and your carpet and your blinds to stay warm. Like, it'll work for a little bit, but your house burns down. And that's the same kind of thing. Trying to scare money out of stocks into bonds is the same dynamic, because you're going to turn around and, Alan Greenspan said it in 2015 and nobody listened to him at the time, which, not a lot of people recognize that if the stock market just stops going up, doesn't fall, just stops going up, the United States will very quickly have a fiscal problem, because stocks have become such a critical incremental part of tax receipts. He said it at a Peterson conference. People didn't believe him.
Well, it's funny you brought up Greenspan, because he's been warning about stagflation for years too. But he actually, for policy, the Fed was promoting the wealth effect for decades. You mentioned 1995. That's around when the Fed started actively promoting in the Wall Street Journal, the Washington Post, all these other major publications, TV interviews, the wealth effect, which I would call, as an Austrian school economist, the Cantillon effect. So they were intentionally trying to inflate asset prices to talk about how good the economy was, get consumers to spend. But the main reason, in my opinion, Luke, was the tax receipts. So if home prices are going up, the stock market's going up, not only is the consumer spending more, the government's collecting way more money in tax receipts for devaluing the currency.
Yeah, at the end of the day, I think it came down to increasing Washington's wealth and power, right? If you're going to manage the dollar and the global monetary system the way they wanted to manage it, then they needed the asset price appreciation.
Well, that's the easiest way to grow tax receipts is you inflate the asset prices. So the average person thinks they're getting wealthier. They go out and borrow more money, spend more money, maybe make some investments into a business or something because they're like, oh, my home price is going up a lot, my stock portfolio. But the real economy was not growing at the levels the asset prices were. Look at the salaries to home prices were at like the enormous distortions.
Yeah, that's exactly it, and it's all sort of it's all a policy choice. It's all a trade off, right? As I've had economists tell me, uh, as long as you hold constant or ignore the geopolitical impacts, and that ties back to the point on China and Russia, which is this was all done with a view that China would turn into South Korea or Japan in terms of being a benign, benevolent creditor willing to accept negative real returns on US Treasury bonds forever in return for US protection. And that changed for a number of different reasons, or that didn't go the way they thought it would. And so now, starting around 2010, 2011, the US military is saying, hey, guys, we have offshored so much of our production that it's now a threat to the US defense industrial base. We are borrowing money from China to build weapons to face down China, using components made in China in factories that we offshored from the US to China. And now you're asking us, you're telling us that China's our number one adversary. This doesn't make sense. And that's where sort of the academic economists that run things at the Fed and that advise the Fed, they look at that in a vacuum, the implications for U.S. national security, and to your point, the implications for political cohesion within the United States. The reality is that a nation's middle and working class provides that nation its political stability. And if you embark on a monetary policy, a economic policy for several decades that hollows out the middle and working classes, sooner or later you're going to have you're going to politically destabilize the country in question. And so I always kind of laugh when I see these economists say, oh, the Krugmans of the world of political, pensions and this, like, how did you guys think this was going to go? Like this, you hollow out the middle and working classes, add 20 years, and guess what you get? You get political destabilized. And that's where we are. So it's as long as you ignore the impacts of political destabilization, as long as you ignore the national defense threats to national security by hollowing out the defense industrial base as drastically as it's been hollowed out, then hey, asset price driven economy and recycling dollars and financing Washington deficits, it's a policy choice. It's a trade-off. But those are very big, those are very, very big X's.
It seems like the math problems are just getting worse. They've created divisions among race, class, age, gender, ideology with all the problems here. And a lot of it's because the average person working their salary, they can't afford a decent standard of living. They can't go and buy a house. They don't have a stock portfolio. It's just becoming harder with all the stagflation and taxes to even have a decent standard of living now. And then the affluent, the last couple decades, have benefited heavily from all this asset price inflation. So you have record amounts of wealth disparity.
Yeah, and that's that is problematic over time. And initially in the 90s and 2000s, it was sort of part of the zeitgeist, and the worm has certainly turned on that, I would say, over the last decade, and that is problematic. And there's not an easy fix to that per se. Ultimately, if you significantly weaken the dollar, the fix, in my opinion, is you end the US Treasury bond as primary reserve asset. You switch back to something that's neutral like gold. That will, by virtue of the market impacts, lead to a much, much weaker dollar. And then suddenly you're going to see high inflation, but the US is going to be able to compete on something other than exporting bonds other than exporting currency. We're going to be able to compete on making things again. We're going to be able to reshore our industrial base in the ways that we're now talking about wanting to do so. But again, trade-offs, what loses? The bond market loses. And because our debt is what it is, that necessitates the Fed coming in at some point and capping yields, because the United States government simply cannot afford the market to set rates for it with debt as high as it is. Through that process, it requires a severe period of negative real interest rates, where we did what we did during World War II, which is the Fed capped yields at 2.5% at the 10-year, 3/8% at the front end, and people got paid every dime they were owed, and they lost a lot relative to inflation.
Yeah, so they got paid back nominally, but in real terms, they got inflated away. So their real purchasing power was destroyed. But in that scenario, Luke, it sounds like the holders who own a lot of US Treasuries, so the pension funds, the insurance companies, because it's legally required for insurance companies to buy a lot of, at the state level, a lot of in different states buy a lot of US Treasury bonds. And then a lot of the banks, either private foreign banks or US banks, sounds like there's going to be trillions of losses in that scenario if your scenario plays out.
Nominally, or excuse me, on a real basis, yes. They'll get paid everything they're owed. In theory, their asset bases will rise over time, right? So, the inflation of home prices means they'll be replacing old home loans with more expensive home loans, so their asset base will rise. But yeah. There's sort of no getting around this. They're going to lose either on a real basis or they're going to lose on a nominal basis. That's unless we get an energy productivity miracle. That's what they're looking at.
Well, I'm a big proponent of nuclear power, but a lot of countries aren't investing in it yet. So hopefully we'll see a nuclear power bull market and some innovations with next generation nuclear power. So that would actually lower the electricity cost for a lot of people across the board.
Absolutely. And there's a lot you can do there. And again, there was a great testimony given to Congress about 2-3 months ago by Josh Wolf, and he highlighted that a 1 gigawatt nuclear power plant, traditional nuclear fission, costs $12 billion in the United States and $2 billion in China. And China is using nuclear fission diplomacy, essentially, going to countries and say, hey, you're short water, but you're next to an ocean. Let us build you a nuke. $2 billion. You run a desalination plant off that. Your standard of living goes up, and then you're tied in with us for the next 30 to 50 years in terms of supplies, maintenance, etc. I took that as really interesting on a number of fronts. Number one, that's the case. But number two, if we want to compete with China, that gives you a gigawatt's a gigawatt. A nuke plant's a nuke plant. We want to compete with China. We want to be able to engage in nuclear diplomacy, nuclear power diplomacy on our own. We better get a lot more efficient, or we better devalue the heck out of the dollar, because on a gigawatt per gigawatt basis, relative to the yuan, the dollar's 83% overvalued. Right? So, 12 billion versus 2 billion.
So if I were to summarize what you're bullish on long term, maybe not in the short term, or there's a trading range that goes sideways or slightly down in the short term, you're very bullish on non-ESG energy plays. Is there anything else then that you're bullish on that you think is in a bull market? Because the conditions here with government policy, central bank, it sounds really dire, but I'm sure there's going to be a bull market somewhere.
Oh, I think there's a bull market in gold. I think there's a bull market in Bitcoin. In these neutral reserve assets. I think there is also going to be a bull market in a lot of different types of stocks for a simple reason, which is there's $130 trillion in debt outstanding. That $130 trillion, a big portion of it, does not realize yet that it is the proverbial sucker at the card table. It's going to lose on a real basis. It has to. Because if it doesn't, it's going to lose on a nominal basis. And so that $130 trillion in debt, I want to say global stock market cap is 60 trillion, 65 trillion. So as that $130 trillion figures out, I need to own something that is going to better preserve my purchasing power, it's going to try to squeeze into the $60, $65 trillion equity market globally. It's going to try to squeeze into the $12 trillion gold market globally. it's going to try to squeeze into the 600, $700 billion Bitcoin market globally. And so that to me is that is the big trade to me. It's actually paradoxically a big long. When you have a sovereign debt problem, other assets don't go down. I mean, they might go down initially, but ultimately, sovereign debt is almost always made whole by the central bank, and and as a result, it's almost always inflationary. And so when you've got the debt market so much bigger than the equity market, than the gold market, than the Bitcoin market, that to me that's a secular trade of just the debt market being, oh gosh, I need to get into something that preserves my purchasing power. Sells, rates go up, you move into other assets, rates get to a level that the sovereigns can't afford, the central banks come in, backfill, QE, grow their balance sheet, the assets go up, wash, rinse, repeat. And I would argue we've been in if you look at a chart of S&P over TLT, right? That's the S&P 500 over the long bond in the US, over the long bond ETF. That chart is up and up and up and up and up, and I with pullbacks, and I think that's going to continue. You look at GLD over TLT, up and up and up and up and up. I think the same kind of thing. Bitcoin, obviously, same thing. That's those are the those to me are the secular bull markets of the next 10 years. I like non-ESG commodities a lot. I think they'll benefit. I think within the S&P 500. In stock markets, I think we will see through this trend a vicious sector rotation towards commodities and industrials and away from sort of high multiple big tech in coming years as well. So those are some things I'm excited about.
Sounds like a lot of stuff that central banks and governments can't print, and they're starting to realize that if they want to switch us over to electric vehicles, there's not enough copper, there's not enough silver, there's not enough of these other key metals.
No. No, and that's the problem. There's not, at least, again, if we had no debt and so we could let copper run to whatever price we needed to grow production, if we needed to let oil run to whatever price we needed to both spur oil production, but then also really provide a true economic incentive to electrification, we could do that. But with the debt where it is, we can't. Because if we let those prices be achieved, the underlying, the implied inflation rate will be so high that the Western governments in particular, but sovereigns more broadly around the world, won't be able to afford the rate without the central banks printing the money.
Well, plus the auto companies. I mean, if gasoline goes to $10 a gallon here in the United States, I think the auto companies, they wouldn't sell any sport utility vehicles, especially at 8% auto loans, which are already starting to default. So you start to see just companies that are relying on the consumer economy and cheap energy, cheap electricity, low interest rates. Those companies would be potentially bankrupt very quickly or in need of a government bailout.
Conceivably. It is it's tricky. It's a very tricky situation. Yeah, you would have to probably do some levels of restructuring. And again, restructuring you can do when you're equity based. When you're debt based, it's a lot trickier. Leverage cuts both ways.
Yeah, I agree. Well, Luke, I really enjoyed our conversation today. There's just too much debt at all levels of society right now, and for it to be refinanced at higher rates, I mean, there's a math problem here at all levels of society, government level, corporate level for a lot of corporations, the small caps. We're seeing that at the small business level, family level, and at the individual level. So it's going to be a mess unless the Fed cuts rates soon.
They need some more liquidity from somewhere, for sure, in my opinion.
Well, let's definitely have you back on in the future, in the not too distant future. I really enjoyed our discussion about energy. That was a surprising answer, but it makes a lot of sense.
Oh, I appreciate it. Yeah, I'd love to. So thanks for having me on.